Good morning, everybody. This is Chris Smith from the Option Club. We are back for part two of Mark Sebastian's presentation on trade selection. The last presentation we did, which is now available in the video archive, focused on what, for lack of better terms, we'll call single month or single expiration period trades, such as iron condors and butterflies. And today, Mark is going to jump into the multi-month trades, such as calendar spreads and diagonals, and discuss some of the things that he thinks are important when you're considering these types of trades. Mark, you there?
Yeah, hey, what's going on?
Well, not too much. I just thought we'd do a presentation today.
Whoa. We're doing a presentation today?
We are.
Why didn't you let me know? I would have prepared something.
Well, you'll just have to wing it.
I guess I'll just have to wing it. So,
yeah, but I think you're up for it.
That's what I'm known for, is winging it.
All right. So I'll just remind everyone this is an educational presentation. No matter what Mark says, he's not giving you investment advice this morning, but he is trying to help you understand the subject of options a little bit better. Mark,
yeah.
Why don't you teach us something about options?
All right, that sounds great. So you want to pass me the presentership?
That would help, wouldn't it?
It really would. It's hard for me to start teaching if...
All right. It's all yours.
All right, guys. And welcome. So we're going to get it back into, the proper trade. There is no the right way, part two. Okay? Presented by Option Pit. All right. So, quick review of last session. Okay? There are a lot of myths perpetuated by those that want to make things sound easy. Okay? There are, you watch. I was actually at a presentation yesterday, and we got into debate about whether Jim Cramer was good or bad. And full disclosure, I work for TheStreet.com now. I do write for them, write a daily column for them. But it's so people want to see this kind of, hey, trading's exciting and it's fun and it's easy and everybody can do it and it only takes 15 minutes of your time and blah blah blah. And I think that anybody who's been trading, who's actually given it a go at trading, would tell you that that's clearly not the case. One of the guys at the presentation, this was at the CBOE, pointed toward the floor, and now granted, most of the guys that trade equity options are now upstairs in a desk, but in the SPX pit there are just a ton of guys there that are there all day. Okay, if it was easy to make money in 15 minutes, this SPX pit would be empty all the time. Okay, trading's not easy. All right, trading is hard. There are no surefire ways to trade. Okay, systems, blah blah blah, blah blah blah. There's just no surefire way. All right, and then we mentioned how consistent approach works and consistent trade does not. There's a big difference between I look at the set of circumstances every month, and if I see this set of circumstances every month, I enter this type of trade, versus I do an iron condor 45 days out every month regardless of the situation. Okay? In Russell. Okay? Something like that. That method we found it's not working. Okay? And I'm not going to get too deep into why that method isn't working. It's kind of a theoretical, hey, let's look at how implied volatility is running relative to historical vol, and yada, yada, yada. But needless to say, trading is getting harder and harder and harder as markets are becoming tighter and tighter and tighter. Okay? Implied volatility does not move uniformly across, and this is a review for yesterday, does not move uniformly across the curve. And by that I mean unit puts move differently than your 25 delta put, which moves differently than your at the money options, which moves differently than your 30 delta call, which moves differently than your 10 delta call. If we look at front month options, or any option for that matter, every option has, a curve. This is what we would call an investment curve. This is what most stocks look like. And if you look at VXX or if you look at oil, it has what we call a commodity curve. But this curve moves. This can be going up like this. This option may be going up a little less. We can be going up more here, just a little bit here, and then possibly even down here. The curve, which produces a different curve. Okay? The curve moves. So after something like that, you would end up with a curve that looks like this, which would be clearly flatter with a higher, this is a flatter curve that we just produced with a higher kind of at the money vol. So the curve does not move uniformly. All right, but one of the cool things we discovered, all right, in our process is that by examining the IV curve, what the IV curve looks like, how steep the curve is, traders can enter more favorable trades. Now notice, I didn't say good trades. I didn't say bad trades. I said more favorable. Going into the 2001 Super Bowl, or was it 02 or 01 when the Rams lost to the Pats? Or going into the Super Bowl where the Pats were playing the Giants. Okay? This way I can make Pats fans feel good and bad at the same time. Going into the Super Bowl versus the Rams, if you were a betting man, the more favorable bet was, may have appeared to be the Rams. That doesn't necessarily mean the Rams are going to win. Just like the more favorable bet for the the Super Bowl in 07 when the Pats were playing the Giants was the Pats. But, the Giants won. So there are some, we never know exactly how things are going to work out. But by putting ourselves in the best odds, okay, that is how we get ahead. If I make a bet that is a 50-50 bet that pays me 55 cents if I win and I lose 45 if I lose, I will do that bet over and over and over again, and over time I'll win. Getting into more favorable trades is very similar. If you give it time and if you consistently enter favorable trades over your life, that is how you win. Okay? Continuing on. All right, the term. All right? I call, multi-expiration trades, multi-month trades, term trades, because you're dealing with different terms. And I talk about term structure, okay, which is very similar to bonds. Just like the interest rates on a T-bill move differently than interest rates on the 30-year bond. Same thing with implied volatility on options. All right, implied volatility does not move uniformly from month to month. At any given time, the at-the-money IVs can be moving in different directions. All right, and at any given time, skew can be moving in different directions. Okay, so we're going to talk about kind of just real brief, and then I'm going to get more into it, but let's say we have two nondescript months, and one month its IV curve looks like this. Another month, the IV curve might look like this, okay? This relationship is not stable. It is not stable, okay? You will see, this curve can move down while this curve moves sharper. Vol can drop in the center, and vol could drop less in the center. Vol could increase in the call. Vol could decrease in the calls in another month. So you have this constantly kind of sliding relationship. Now, they do have tendencies to correlate, but that just because you correlate doesn't mean you move exactly the same, right? The Dow Jones Industrial and the S&P 500 correlate. That doesn't mean they are exactly the same, okay? The Russell and the NASDAQ correlate, again, does not mean they are exactly the same. All right, the term, generalities, all right? Front-month options are more sensitive to changes in the market, all right? This means, all right, at-the-money IV explodes and deflates quicker, all right? Skew steepens and flattens quicker, all right? I liken the front month to my crazy uncle, okay? You never know, well, no, yeah, my crazy uncle. You know, he was a volatile person. He's not, I really don't have, well, he's a volatile person, and he can, you know, explode and then be happy in the next minute, or he can be super upset and then be super happy, or he can be depressed and then all of a sudden in a great mood, okay? Versus, you know, Al Gore, all right? Al Gore, you can just tell he's the type of guy who's just like, this is me, I am Al Gore, I am relaxed. But you can tell deep down, if something really sets him off, that's a guy, you know, he may explode. I don't want to be political here, just saying. You know, another way to maybe compare would be a sport bike. The front month is kind of like a sport bike. If you know, sport bikes get, you know, anybody who's seen them, they can go really fast, really quickly. And they can stop really quickly. Whereas back month options may be more like a big truck, okay, that takes a while to speed up, and once it decides to get going, it takes a while to slow down, all right? Anybody who's seen a train try and stop, it can take a freight train, you know, a mile to stop sometimes, because that's how they work, all right? So the front month is constantly in motion, all right? It's never just perfectly stable, and it really moves around. All right. All right, back month options, as I was stating, slower. They're much slower. They're like the sloth, or they're, you know, they're like that sleeping giant that you don't want to set off. Okay? Back month options move slower in both IV and in skew, all right? And the further back in time the option is, the less sensitive it is to small changes, and the slower the IV and the curve move. Okay? So, let me kind of, going back to our paint, all right, we have this, we'll call dark blue, this kind of dark bluish, the front month, all right? And then we'll call this dark blue, I'm going to draw the front month. And then we'll call this green the back month. All right? Now, with slight changes in volatility, movements in the market, you'll see the front month do this or do this. You know, this is this is the IV curve here. All right? So you can see IV levels. the front month will flatten. It'll move around like this constantly. All right. Notice the back month may not move, but if you see, the back month moves around. If the front month starts moving around, if the back month does move, this move, just a slight, has a much greater effect on the P&L of the position. Can anyone tell me why back month option vol movement has such a greater effect on a position? Any answers here?
Well, we got one person saying it's because of gamma.
Okay.
We got someone saying higher vega in the back months.
Okay. Anybody? Any other guesses?
No. I'm going to tell you because what you end up living with after all the front month options expire.
Yeah. It's all of that. It's all of that. The front month is because of gamma, and the back month is because of vega. And absolutely, it's because of kind of what you live with. All right. The key is that, yeah, when the back month isn't going to move very much, but if it does, it causes a massive ripple. Think about this. Here's a good way to liken it. If you run a business, you have a short-term line of credit, and maybe you have a big 30-year mortgage on your house, okay? Now, you're in a 5-1 arm on your mortgage, all right? If I go, I just went and refinanced my mortgage, and they dropped my rate by, we'll say 1%, okay? Over the life of that mortgage, right, how big of a monetary effect is that on my pocketbook? Massive, right? Now, if I've got a short-term line of credit and I'm kind of in there and out there all the time, if I have if I'm borrowing and in and out of 50,000 bucks on on a 20-day rolling period, and my interest rate goes down a point, I may not even notice, okay? Because it just the net effect, the increase in value is just over the life of the option is really what causes it. So because of that, similar to T-bills, similar to bonds, that front month option is going to be really ticking around with vol in the same way that T-bills move around with interest rates. Meanwhile, my back month options are like the 30-year. Okay? Yeah, those 30 years, they're slower to move. But when they move, it has a profound effect on your net worth. Does that kind of make sense? All right. So, getting back to things. All right. When trading calendars, it's important to pay attention to the vols being traded. All right? Because of the relationship between the terms, it's very important to sell and buy the right volatility. The relationship of the terms is where the concept of weighted vega comes from. All right? Relationship. That's funny. Fixed. You guys didn't see me just repair that, right? Nobody saw that, right? The relationship of the terms is where weighted vega comes from. Now, what is weighted vega? I did a big thing on this actually a while back for the Option Club, and I wrote an article for SFO. It basically is a way of trying to quantify the relationship between months, okay? And basically what it says is that, if vol goes up a little bit, the front month is going to move more. And it helps try and manage your position so that you're taking into account that front month and back month sensitivity. Okay? And the real key here, all right, is that you have to monitor how those two relate, all right? If you sell to the relationship when it's off, okay, then you're setting yourself up for disaster, all right? We've just described that the front month moves a lot quicker than the back month. So if this is my front month option and this is my back month option, and I buy a calendar where I'm buying this and selling this, all right, what do you think I'm setting up to happen? What do you guys think is being set up here? And, you know, there was a discussion on the board about an XLE trade, and this was kind of my issue with the trade. Especially in a time like this where, and I'll talk about this briefly, volatility of volatility is high, okay? Where what that means is IVs can go up or down very quickly. Okay? So if we're in an environment where IVs can go up and down very quickly, all right, and I'm setting up a trade where I'm selling the front month for cheaper than I'm buying the back month, what do you think I'm setting up for? All right, how do you think my position is gonna perform here? What would be the pitfalls of this position? Chris, any answers?
Our month will come to front as front expires. I think they're saying the back month will become the front month.
Well, yeah, that's one. There's more to it than just that. All right. If we're in an environment where vol is high and IVs can move around quickly, and I set up a trade where I'm selling the front month below the back month, and we've already established that the front month moves a lot quicker than the back month, how is my calendar going to do if this spikes, or if the front month spikes, the back month drops, or worse yet, we get a combo of both? How is that going to affect my calendar?
Everyone's saying you're going to lose money.
You're going to lose money quick, okay? Now, is it possible to still make money in this calendar? Of course, okay? It is possible to still make money in this calendar. If I set up this calendar this way and vol doesn't move and the market just sits there, I'll end up making money. But in the environment that we're in, has the market just been kind of sitting there very much? No, okay? You know, and we've established that you need to set up favorable conditions, okay? So if I set up favorable conditions and I don't do something like this, I'm going to be in much better shape. So, you know, we'll continue on this discussion momentarily, all right? Do's and don'ts for term trades, all right? Here's the do's, all right? Be very conscious of the skew between months. I actually hate calling it skew. I call it term structure, but there are a lot of people that call it skew. When I think of skew, all right, I'm going to briefly explain this. For most of the professional trading world, all right, they think of skew as the curve, all right, not the relationship between the months. The relationship between the months they would call term structure or the term relationship. So just going forward, if I say skew during this presentation, I mean the skew of the curve, all right, not the skew of the relationship between the months. All right, but be very conscious between the term structure of the months, all right? Be price conscious. Watch levels of overall volatility. Monitor the above while in trade. Monitor the steepness of each month's skew. Okay? Don'ts. All right? Do nots for term trades. All right? Trader, diagonal or a calendar just because IV is low. Okay? I'm going to go through a couple of examples here. When IV is low, that doesn't necessarily mean the trade's going to go well if you buy a calendar. In fact, often it will go horribly wrong if IV is low and you throw on a calendar. All right? Don't assume that because vega is flat that a position doesn't have volatility risk. All right? Don't trade the same diagonal or calendar every month regardless of conditions. If I can accomplish one thing working with the Option Club, it is to kill the concept that you can trade the same thing every month regardless. All right? Calendars and diagonals are tough trades. All right? Anybody that says they're an easy trade or they're simple or that you don't have to work hard at them is either not trading, lying, or stupid, or all of the above. Okay? And don't ignore what the market is telling us. You know? It's like the market, you know, you ever done something really stupid and before that all of your buddies are saying, you know, that's a really, really bad idea, or hey, Mark, really, really bad idea, or hey, guess what? That's a really stupid idea. You know, sometimes that works out. I've done some horribly awful ideas that have ended up working out. But over my lifetime, when I've been warned by 2 or more people that something's a bad idea, what do you think happens? It usually ends up being a bad idea, right? Okay. All right. Calendars, all right? The one key to success is the right price, okay? And this is achieved by monitoring the intermonth IV skew, all right? So, by monitoring this intermonth relationship, the relationship between the front and the back, this relationship I can set up trades that are more favorable. All right? Just looking with ignoring the rest of the curve, looking at the money calendars. I want this to be the front and this to be the back. All right? Why? Well, normally, if you look historically, the front month was always a touch higher than the back month. It's been a little opposite of that over the last few years because everybody's deathly afraid of kind of vol, you know, exploding on them. But that said, we need to try and find calendars where the relationship looks like this or this. And you know what? You can usually get away with even this. You can't get away with this. All right? I've seen hundreds and hundreds and hundreds of calendar trades. And the ones I've seen where this is relationship, almost like clockwork, this drops or this explodes. All right? It is like clockwork. Either way, that relationship, when this relationship moves, it's, I mean, just kind of to put things in perspective, all right? If I set up a position where my front month is here and my back month is here, intuitively, if you had to make a bet on which way this relationship will go, how would you bet? If you know, it's like you know, if you were just looking at the relationship and you know that IVs move around and the relationship between the months moves around, all right? if this is the back, we'll put a B here for back, and this is the front, intuitively, what do you think is going to happen to this position? Right. I mean, they're going to at least converge. All right? And this convergence is bad. What I want to do is set up a trade where convergence is good. So if I set up a trade where my front month is above my back month and they converge, I'm going to make money. And I'll be happy. That's actually this is a picture of Chris. So that's Chris making money. You want to know why Chris is making money? Because he understands the relationship between the front and the back month. All right? Now, how do I figure out the price based on volatility? And this is actually going to be a little mathy. So, well, it's not too mathy, but I think, you know, if I can accomplish one thing, it's to open your guys' eyes to kind of what you're fighting when you put this stuff on, so that you guys can go with, you know, you guys can get yourselves in a position to understand what the competition understands. All right? One second. So, you know, from looking at the price, all right, what price should I trade a calendar at based on skew, all right? So here is the spiders, okay? And we were looking at AUG-SEP at the beginning of the week. All right? All right. And everybody's seen toss before, right? Nobody has any questions about what they're looking at? All right. If you look at Thinkorswim, you can see implied volatility right here. Now, one of the issues with Thinkorswim is that they don't properly account for the cost of carry. So when you're calculating IV, implied volatility in Thinkorswim, you actually have to aggregate the numbers. So what is the mean of the front month? 19.41 and 22.11. What is that? It's 20.76, okay? And our back month, our September, is 22.36, all right? So what's 22.36 minus 20.76? Now, .6%. That is way, way, way too wide, okay? I would never, ever enter a calendar if it had a negative term structure. I won't do it. It's bad, bad, bad news, okay? That is just a train wreck waiting to happen, all right? So I'm looking at these two spreads, and you know, we've established they're both bad. What kind of price improvement would I need in order to make this spread favorable? Okay, what price should I be bidding for this calendar? And minding that this calendar price is going to trade every day. If I was looking to enter this calendar today, okay, and I needed this relationship to be even, I need to make up for 1.6% of vol. All right. Well, what is the vega on the 110 line? 11 cents. So what that means is that a 1-point movement in volatility, all right, up or down, all right, what is the net vega of the relationship? So a 1-point movement in August would increase vol by, or would increase the price of this option by 11 cents. If we look at September, the vega is 16 cents. So if we increase vol by 1% in September, September options gain 0.6. All right. So the net vega on one calendar is 5 cents. So a 1-point increase in vol, all right, would cause this calendar to increase in price by 5 cents. All right, so if I need to get this calendar at even vols, I'm going to figure out the vol spread, which is 1.6, and I'm going to multiply it by the net cents of vega. So times 0.05. I need to buy this calendar for $1.17 today. All right, remembering that this relationship, this price changes every day because of decay. I need to buy this calendar for $1.17 in order to have a flat skew. So I would actually probably go for $1.15. Do we have any questions on that?
Actually, I think a couple people have a similar question. I think it boils down to this. If you would not want to buy a calendar with a negative term structure, how about selling it?
Yeah. You know, that can make some sense. It absolutely can. Now, here's the issue with that. You've got that decay problem, okay? And we never know exactly when that's going to happen, but if you and the other problem is, and here's why some of these things are so ridiculous. They just blast you with margin, okay? If I was in a portfolio account or if I was on the floor, when I was on the floor and I could basically borrow at 1%, you guys know that, right? How market maker, at least when I started, market maker margin was 1% against your haircut. So if I had $1 million in haircut, oh no, it was 10%. I had to have $100,000 in the account, and then my firm made me put in 10 grand against that. So it ended up I did 1%, they did 10%, and then later on as things got a little crazier, they moved that to like 3-1 or 4-1, I think. But the problem is that let's compare margins of the two trades. And this is one of the issues I have with you know, how FINRA operates. What is my buying power effect in Thinkorswim on this calendar? $1,250, right? If I flip it, look at the margin. $25,000. All right? Because of that, and it's ridiculous, by the way. You would have to be, you know, one of the all-time stupidest people to lose $25,000 trading this calendar. Okay? I mean, you would just have to be, like, stupid on a monumental level. I mean, we're talking, just incredibly stupid. I can't think of, you'd have to be so stupid that I can't come up with anything analogous to how stupid you'd have to be. That's how stupid you'd have to be. So, but the margining stacks the deck against you, and that's the main reason why I wouldn't want to do that. Now, with guys that have portfolio margin, guys that have PM, then, yeah, that's something we work with. Now, if you want to get long gamma, there are usually different ways that I approach getting back spread and having, flat or short vega that makes some sense, rather than just the reverse calendar, or the a short calendar. But yeah, that could make some sense if you have portfolio margining. Does that kind of answer that question? Yeah.
I think it probably did.
Yeah, Chris, can you imagine, how would you lose 25 grand trading that spread?
I'd have to be stupid. I'd have to be so
How stupid would you have to be? Sorry, I get fired up sometimes because it just blows me away how, in my opinion, smart retail traders are much safer bettors than, some of these big bankers, because it's their money. Now, there are some dumb retail traders out there, but they don't put on that type of spread. All right, so that's kind of calendars, and I'll go through some examples here. I'm gonna go through calendars and double diagonals kind of at the same time. Examples of both. Double diagonals. All right. Again, one key to success: the right price. How is this achieved? All right, it's by monitoring two things. Okay, it's by monitoring the inter-month implied volatility spread and the inter-month strike-to-strike skew. So this is where double diagonals can be really good if you can get in at the right price. They can be an awesome trade. And here's why. All right, you set up a double diagonal where the front month has skew like this and the back month has skew like this. All right? And what we're shooting for, and this is basically how some of those diagonal earning plays work. If I can sell here and buy here, and I can sell here and buy here, all right? We were talking about relationship convergence, right? What happens when this comes in and these flatten out, or the back month increases and steepens? How do you think you're going to do on that double diagonal? You're going to make a blasted killing, all right? And that's kind of how some of these earnings trades play out. I mean, it's really true. I want to show you guys a trade I was looking at with a potential client, and the guy was like, well, I don't understand how I lost here. And, well, then I went through it and kind of showed him, why he got beat. And I thought it'd be interesting to point out. Here we are. It was on the 19th is when he entered. So we're going to look at a double diagonal here. And this is an earnings double diagonal, but there are double diagonals where you can make money pretty quickly trading a regular index. I put on a double diagonal of diamonds that made a one lot that I think made like $50 in a day. It was ridiculous. So here's Goldman. This is called Option View, and I'll point out all the different things on Option View. It's a neat little program because it lets you do half-an-hour intervals. It does have its kinks. It's not the perfect trade. It's not the perfect system, but it gets the job done. And so I'm not going to sit here and complain about it. So what the trader had on was he had sold this, bought here, and then sold, I want to say, the 140s. It may have been the 145s for all I know. Either way, this will work. And then bought the 135s. And now, here's the neat thing about this. This front month skew, the vol is higher in the front month if you look at the monies, right? And let me go large, large, large. And yes, and 1 second here. I want to get the vols right. And I want to switch it to off of the Yates model. One more thing. I don't want to hit bid ask. So here is kind of your, you're even, you're selling a call with higher vol, and you're selling, even though the strike is closer in, okay, we're basically selling the same vol. So what we've done here, like we try and accomplish, and this is what these earnings double diagonals look like. And they do happen when there's not earnings. So this guy had sold here, and he bought here. So he was taking advantage of the sharper skew. And then we're going to convert it, which would be, all right, so now you can see I'm short 10 of the August 150 calls, long 10 of the September 155s, short 10 of the 140s, long 10 of the 135s. Okay? And then you can see, when did they announced earnings, I think, on the 20th, right? Yeah. So you can see this guy made a decent amount of cash in a pretty quick time, and look what's happened in the vols. September's kind of stayed up, and the front month has gotten smoked. I mean, this is literally how good he was doing. He was up like 14% based on his prices, and the vols had gotten smoked. So now he's got a position on where the back month didn't really move, but the front month, it just flattened out to look like this. So now he's got this trade on, and he's got $1,000 in his pocket, and he's got this relationship on. He's made 10% in 3/8. And here's where I got annoyed. He didn't take off the trade. And then watch what happens over the next few days. Keep an eye on these volatilities. What's happening? I think right here is where things go really south. Yeah, here's all right. So you can see the relationship. The back month's been getting smoked. The front month has held steady, and this position starts bleeding money. It's not bleeding money right now, but I know it does. And here you go. He held on to this position and set himself up for disaster because he left on a position that looked like this, which is an unfavorable trade. Once this trade gets this unfavorable, where this relationship looks like this and the skews are flattened out, you've got to get out of the trade. All right? There's a big difference. Let me just kind of quickly expand. So here's the back month. Here's the front month. If the front month goes to something like this, you know what? Be my guest. Stay in the trade. All right? If the front month looks like this and the back month comes up a little bit, you know what? Stay in the trade. Be my guest. But if the front month drops like this, all that's going to happen is you're going to give up whatever money you have. All right? Now, let me go back to Monday. And I mentioned this in my midday pit report. that we do every day for our option pit members, we were looking at the SPX. And I was saying on Monday that if you could get in at the right price, that an SPX calendar wouldn't be a bad idea. Now, looking at this, what is this thing marking off the calendar at? Almost $12, right? One second here. I need to add some strikes. So yeah, we were looking at this trade on either Monday or Tuesday or Friday. It was one of those days. When were we at 1090? Am I boring you? And, you know, we were looking at prices, and I said, well, if you can get in this thing at $11, all right, notice the price here. It's not 11 bucks, right? What the? All right. If you can get in at the right price, where instead of doing 15, you got in at 29 and 40, you could make money. And that's what it kind of came down to, was that there were circumstances where it made sense, and the guy threw out this trade on and ended up, I think he got out on Friday? This thing's not doing the profit and loss properly, but yeah, on Friday morning I was meeting with this guy, and he was up 15% on the trade. Something, obviously these prices are not exactly correct, but there are examples all over. Oh, because it hit bid ask. There are examples all over. There you go. So he's up $1,300. This was what we were looking at. He was up $1,300 in about 5 days because he had put the trade on for the right price. And how did he put the trade on for the right price? He put these things on at the right volatility skew. Then when they got negative, like they are now, he went and took it off. I think he ended up making 10%. Now, both of these trades are in the last month, so you can trade these things. You just have to do it for the right price and be smart. All right? Again, trading is hard, but traders that figure out the most favorable time to enter spread have a fighting chance. Buy calendars when front month IV is higher than back. Buy diagonals when front month IV is high, skew is steep relative to back month trade. I mean, it's really this simple. All right? Questions. All right? If you have questions, you can read my blog, the Option Pit blog, formerly Option 911. You can call me, 888-TRADE-01. You can email me, mark@optionpit.com. You know, as always, I have a special deal for my option club members. All right. The first 5 people to email me after this presentation, I'm going to give a free 1-year subscription to Expiring Monthly, which is the magazine that I am one of the managing editor for. Okay? As usual, though, we also have discounts for our members, for Option Club members. All right? If you are an Option Club member and you tell me when you sign up that you are an Option Club member, I will take 10% off of my services. Okay? And I'll tell you, we've had a lot of people take advantage of it, and I think people have it's cost me some money, but it's made some other people very happy. So it's a good thing. So do we have any questions?
We do. Actually, I got a couple comments that I wanted to share with you. John Dory says, laughing out loud, Optionetics would charge about $3,300 to teach what Mark is going over. Great presentation.
Yeah.
So
Thanks, John.
appreciate the feedback.
Yeah.
And Chicken Dave, your mother really can't like it if she names you Chicken Dave.
No, no.
But Chicken Dave wants to know, since you constantly talk about implied volatility, is this the most important aspect of options trading? What other and then the follow-up is, what other aspects to a trade do you consider when placing a trade?
Well, I would say implied volatility. I mean, options are an insurance product. It really at their surface. Okay. Now, if I'm doing flood insurance or I'm doing fire insurance, I've got to run all these probabilities on what the likelihood is of a flood or a fire and write a policy. Okay? Well, that's what for option traders, that's what volatility represents. So I would say that yes, I think volatility, probably more so than anything, is going to determine your success and your understanding of volatility, okay, and your ability to sit there and listen into volatility and what's happening, all right, with volatility, and to understand it and how your position changes. What I just went over is literally the tip of the iceberg on volatility, okay? I get into, like with double diagonals, there's certainly a lot more than just, hey, the curve's tight, the curve's steep, let's throw on a double diagonal. There's certainly a lot more than that, okay? But just, this little bit of knowledge is going to put you ahead of anybody that wasn't watching this presentation. So, yeah, I think volatility is hands down the most important thing.
Yeah. The one thing I'll add to that is if you really understand what an option is and how it drives its value, what you realize is that the entire price structure of an option, to the extent it has any time value or extrinsic value left in it, is all volatility. And I forget who it was. I think it was someone on our Yahoo message board said it best as volatility is price, and price is volatility.
Yeah.
So if you don't grasp the volatility aspect of options, you're trading at a significant disadvantage.
Yeah. Well, and there are 5 main factors. When I talk about the model, right? That's the key, is that it is a model. It's trying to be predictive, okay? Just like, I know I say this and it's awful, but, the guys that were doing the analysis before the Challenger and Columbia took off, some of the brightest guys in the world, and their statistical models did not work, okay? Same thing with the model. It does not work sometimes. And so the key is that, we've got to understand how the model works and what is the factor that we can't control, all right? There are 5 things that go into every model. Every model, no matter how complex, are based on 5 factors: stock price, strike price, timed expiration, cost of carry, and volatility. We can figure out the other 4, give or take a little bit, pretty easily. That volatility component is what we're all searching for. So,
Mark, what tools do you use to monitor the implied volatility relationship between the months and as well as within the given month?
Well, one is my head. You stare at an option screen for 10 years, and you start to see things pretty quick. But I have my guys go through and start monitoring themselves. I have them look at the money vol. I have them look at skew. I have them look at all sorts of things. There are products out there. One product that I really like is called Live Vol Pro. I really like that product a lot, and I use it all the time. Actually, one of the neat things is that I like it so much I called them up and I worked out a deal for my clients to get them a discount that works out to being 25% off of their price. So, you know, everything I'm always doing for my clients is to get them, to get things cheap for them. And there are other things I look at, you know, how's historical vol doing, blah, blah, blah. I mean, the list of things that I work with guys on is extensive. And, you know, I think, you know, there are definitely clients of mine in the Yahoo Club. If you want to ask them about some of the things I go through, please feel free. Or, you know, I don't really want to go on and talk about how great I am for, you know, actually, that's not true. I do want to talk about how great I am for half an hour, but I'm going to choose not to. So if you want to really get into some of this stuff, shoot me an email or call me or something like that, and I'll be happy to give you some pointers.
Now, someone was asking if you can see the skews in Thinkorswim, and you actually can. There's a widget in there, or gadget, I forget what they call it.
Yeah, it's widget 360. It's under
tools.
And this is skew. All right. Here's the and yeah, you know, it's not. This is the OEX. So here is a look at the skews, and you can see the issue I have with widget 360 is it doesn't do. You can't look backwards very easily. You have to do on demand, which takes forever. LiveVol Pro pretty quickly. Here's my members website. I use this. I mean, I am on this site constantly working. All right. I'm a big proponent of these guys. I would say in order of things that will improve your option trading, it goes number 1, Mark Sebastian. Number 2, LiveVol Pro. And now, if you get Mark Sebastian and LiveVol Pro, I don't know how you can lose. If that's not true. You know, one of the things I like to tell people is that, you know, this is really hard. And if I were to go through and have a 50% success rate with students, I would consider that a monumental achievement. So here's SPX. They've got a bad price. They got a bad mark in there. Let me get. So here's the October weekly, or the August weekly. It's running through all the iterations. And it's kind of cool. It just runs through really quickly. And I'll show you, guys, this real quick. I do like this product a lot. So here's a look at how skew is moving. And you can actually see kind of the relationship move around. So it's kind of a neat little product. I like it. So, but yeah, you know, that's a great tool. You need to have the skill set to learn to use it, though. I think that's one of the keys. So, any other questions?
Yeah, Mark, I know you are into weighted vega. Here, is it okay to use just the raw vega in calculating the price to get flat skew? Weighted vega.
Oh yeah, no, you do use raw vega for that. That's not weighted. The raw, by getting a flat skew, you know, that is only raw vega. You don't want to use weighted vega. Weighted vega is a position management tool. It is not a Greek calculation tool, if that makes sense. I'm big on weighted vega. I like that. That's funny.
Yeah.
Um,
We have a
it sounds
request.
like, Mark, you're into cars. I'm into weighted vega.
You put that on your online dating profile.
Yeah, no kidding. Mark likes Patrick Swayze, weighted vega.
Uh, we have
Roadhouse.
a, we have a request, Mark, for you to put the summary slide back up.
Sure. Yeah, I'll send you my slides also if you shoot me an email. That's not an issue.
All right, here's a question from David Birdies. It says, let's say that you have a long-term view, either long or short. What about buying deep in the money leaps and selling out of the money front month options? I don't know if
Not really. Sure, that's a great play. I mean, it's like basically a covered call, except you're using the options instead. Yeah, I mean, that's fine. I actually do that myself all the time. And one of the things that I found is I think leaps are one of the most mispriced options out there. And there are some real ways to take advantage of the fact that some of these boneheads have not figured out how to properly price them, and that they're, because of a lot of these really intricate and complex firms don't want to deal with leaps. There's a good way to kind of pop in there and get at them. So, yeah, I think that's a fine strategy if you have a long-term view.
Okay, we've got a bunch of people saying thanks, great show, comments of that nature.
Good. I'm glad you liked it.
Here's a question. It says, Mark, if one buys calendars in SPX when the front month is over the back month implied volatility, isn't that likely to be near the bottom on a big downdraft? And isn't there a big risk of price movement that might negate what you get from the volatility normalizing?
That's a good question. And, yeah, that can be an issue. That's why you don't just, like I said, there are a lot of things that go into this stuff. When we're in a huge downdraft, a lot of times I would set those things up a little bullish. But one of the things we found is that if you set up the calendar, even on a huge downdraft, the right way. So here, let's go into option view. Let's pick a time where vol was really high and set something up. You know what? We can go back to the flash crash. How does that sound? Let's go to May. I don't want to go to May 7th because that's just no one in the right mind would enter anything there. But let me look around on like May 13th or something like that. How does that sound? Is that fair? I don't think anybody in the right mind would say, hey, enter a calendar today, But here we are. We're at a logical. Vols are definitely high. We've come off. I could move it back to heck. You know what? Let's throw one on this Friday. I'll do it. I'm not going to do on the lows of the market because I just don't think that's fair. But I think we rally back by today. Yeah, here we go. I don't know, Chris. What do you think? All right, here we go. All right, we're down 10. We're off the vols. Vols are still really high, though, right? Look at what we got here. We got a nice skew here. I want to make this tough on myself, so here we are the next day after being up huge. And yeah, we lose because we lose, we get 36 handles, but that was off the biggest, the worst move ever. I forget how many days in a row. I think we do start to kind of fall right back, though, don't we? And actually, the front month vols are still, if you look, yeah, we're not even out of our tent because we set this trade up right. Now we are, but obviously we're not going to rally 80 points all the time. And I'll bet you if I left this trade alone, it ends up making money. See, look, we made $4 grand. Take that. No, when was kind of like the real bottom of the market? Probably like around end of May, something like that. Let me see. Let me pick a time that kind of makes some sense. You obviously have to make some, like I said, trading is hard. You have to make some decisions about, hey, I should do this or I should do that. Again, just doing skews is not going to be the brightest idea. Trade log. Let me get rid of these this SPX trades. Here we go. So we're coming off a couple of major down days. You wouldn't just sell right into it. And here we are, kind of in this range. We can throw on a 1090 with a kind of a flat skew at this point. And you don't want too major of a skew either. I don't really get into that as much because that's usually not a problem. And most people are not the type of people that'll throw on a calendar after we've been down 80 points in 3 days. I think I might have actually thrown one on around in this time. And we'll just see. Obviously, I don't do a lot of stuff where I sit there and stack the deck. But did I do hit bid ask again? Nope. So it's just kind of a part of figuring out calendars. But this is one factor that will actually make your life easier. So. So I hope that answers his question. That you know what, this isn't the only factor you look at. Is basically what I'm trying to say. Take your time and really learn this stuff, and then, look. I mean, even with the market going boom, 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 up and down, we're not getting worked out of our minds on this calendar. And we ended up making money. And at no point in time, I think, looking at that, were we down 15%. So I hope that answers his question. That you know what, that can lead to that. That's why there's a lot more to trading than just looking at the skews. That is one important factor, though. As I stated, my goal is to kind of open eyes to all the different things against them.
Yeah. Well, I think there's still some questions here, but we're about an hour and 15 minutes into this now.
Mm-hmm.
And as I'm going through these questions, I think we've covered most of this material.
Okay.
And I think it might be a good place where we wrap it up.
Okay. Well, as I stated, thanks again for having me, Chris. I always love coming on and talking to you guys, and my goal is to challenge you guys and to force you guys to think. And this is a good group to speak to because they're for the most part smart, and they want to get good at this. And I don't think you've got a lot of fast money type of people in your group, and so it's really nice to come and speak to you guys. And I just want to thank you again for having me. I really appreciate it. And again, I'm sure there's more questions and comments out there. First 5 people are going to get an expiring monthly from me, and hopefully I will hear from you guys, and maybe a couple of you guys will want to learn how to trade, learn ways to get better at trading from me. So on that note, I'll let you go.
Yeah. Sid's asking real quick, how do you get the expiring monthly?
Shoot me an email, or if you want to subscribe, www.expiringmonthly.com and subscribe there. It's an easy $99 a month, $95 a year, $99 a year, and it's some of the best written content we have, so that I've seen. The guys that work on it are great writers.
All right, Mark. Well, thanks again for taking some time out of your Saturday. And
it was fine. I enjoy getting away from my wife and kid.
I'll make sure they know that. All right, man. Well, thanks again, and
right.
Thanks to everyone who joined us for the presentation. I've had a few people ask, and the answer is yes. This presentation is being recorded, and as soon as I can get it processed and uploaded onto the website, we'll get it in the video archive. So again, thanks everybody, and have a good weekend.
Bye, everybody.